Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Welcome everyone to Property Investing Insights, where we've got a new riff. And I mistimed that because this riff is a little bit longer, but nonetheless, welcome. This is our film version of Property Investing Insights. And for those that hang on to our words like anything, you would have realized that we missed or skipped the last property investing filmed version because we couldn't make the logistics work. We were at the opposite end of the state, and we thought rather than doing it on Zoom, let's do it face to face because we tend to vibe a lot better. And obviously a lot has changed since we last spoke. And the biggest thing as we record this today is this week we had the rate rise, which was talked to death before it actually eventuated. And our run into Christmas is certainly been impacted by that. And what we would want to talk about today is all of those things and everything that's happening around property. But Steve, before we do that, I noticed that KVA is off your budget, so you've lost a lot of weight.
Yeah, got a little bit sick, got a little bit healthy as well. You know, that's what you do when you get to a certain age and you pile on too many kilos. You tend to go too far the other way. But anyway, life is good. But there is a lot happening, Vic. There's we've had the 25 basis points rise, which I think was well politicised. I think the new governor was between a rock and a hard place, really. Yep. And it's what fascinates me is it depends on which set of data notes that you look at and then how you interpret it. And there's two sides to the equation here, and it's a pretty equal, I guess, denomination in terms of those who said it shouldn't have gone up and those that said it should have gone up. And then there's a sprinkling of people that said it should have gone up more. So it's really, and so I feel sorry for the punter, using loose words, on Melbourne Cup Day as well. I feel sorry for the average person because there's so much narrative out there which is so hard to interpret. So what do you believe? You do nothing really. It's above our pay grades. You bury your head in the sand and it'll be what it'll be, and then you deal with the after effects. But nonetheless, 25 basis points, which I think is going to be to some degree the straw that breaks the camel's back.
Absolutely. And if you haven't been taking action proactively as this rate rise has started to happen, naturally you're now caught out because this final or this latest, because we don't know whether it's the final rate rise in this cycle, this latest rate rise may be the one that now actually locks out your borrowing capacity, which may then lead to people potentially selling down some of the investments. We're already seeing that where there are a lot of investors that are actually selling down their hard to maintain, heavy negative cash flow, speculative properties, ones that they had been holding on to saying, yeah, she'll be right one day. And now they're deciding to pull the trigger, right? But what we're not seeing in major droves are your homeowners selling. And I suppose it's because if they sell, they can't guarantee themselves being able to find the next one, let alone qualify for a mortgage for the next one.
Or a dwelling to rent.
Yes.
And I think this is what I'm referring to when I say the straw that breaks the camel's back. I'm not necessarily meaning that it's going to be Armageddon and mortgage defaults are going to escalate to GFC days. That's not what I'm suggesting. What my version, I guess, or my interpretation of the straw that breaks the camel's back is probably three or fourfold. One of them is there will definitely be an element of raised hurt within the economy and within the housing sector. So those that are already on the verge, they're white lining anyways. And this 0.25 will just be, that'll be enough for them. How many of those people? Don't know. But there'll be enough, and it'll predominantly be in the more expensive markets.
True.
Right, where that debt to income ratio is really redlining anyways. I think the other version of the straw that breaks the camel's back is this is going to put more immense pressure on the rental market.
Absolutely. It will,
because those that hold their properties are just going to say, you know what, we're going to do our best to pass that on, which obviously puts pressure into the tenant market. But it'll also be because of those people that do have investments that sell out. The data shows us that those properties are being picked up by owner-occupiers. And so as a result of that, there's less in the pool to rent once again. And so the vacancy rate gets tighter and tighter and tighter. And I think also the straw that breaks the camel's back analogy version 3, and this is a bit of a crystal ball gazing, and it's in and around sort of February, March, April next year. I think we'll see the telltale signs of this rate rise in and around then. And the reason I say that is because I think there'll be an element of people that go, you know what, I'm out. So whether it be an owner-occupier or an investor, right here, right now. So it'll be very interesting to watch the data on market appraisals through the various agents. There'll be the people that'll say, you know what, I'll just hang off till Christmas. I'll enjoy Christmas. Psychologically, I'll compartmentalise it and I'll attack it in the new year. And when that happens, they'll probably start to do that in late Jan, get the market appraisal. So the time that properties hit the market, we're looking late Feb, March, April, right? But the big, I guess, what if is how do the banks react to the hurt?
Yeah, absolutely. And
Right.
and I think we've already seen how the banks are not as willing to foreclose. They're working with the current owners to actually put the property to the market still under the owner's name. So they're not actually taking it off the owner. So they're giving them enough time, and we're starting to see a lot of that in the last quarter. So there's definite distress there, and one of the things we need to understand in terms of traditional definition of mortgage distress is where 30% of your income is taken up by the mortgage. The reality is, if you own a property in Sydney or the more expensive parts in the state, you're already in mortgage stress under normal rates.
Correct.
Yeah.
Yeah, good point.
So then we've also got the rental stress, and with the way most property managers assess the person's ability to pay the rent, they want 30% of the income only, maximum, to be catered towards the rent. And the way the rents are rising, we're going to see the rent stress ideology being thrown around quite a bit in the next year. And certainly one of the things that we need to understand is that if you look at how this is all shaping out, so yes, we've had a rate rise. There are talks of inflation having now peaked or about to peak, but there's still going to be, it's not going to land at the 3% that we wanted. It's going to land more towards the 4% mark. Or 3.5 in that bracket, and they'll creep into 2025, not 2024. So we know that there won't be any, as the data stands right now, there's not going to be a substantial ease of rates in the immediate future, perhaps in the tail end of next year. But I think this rate rise has pushed that out even a bit further with the RBA's take on, yes, we need to throw a little bit more at the inflation problem. And then the inflation itself is unlikely to come down substantially because if you look at it, we've just clicked over 26,800,000 people in Australia. In the 2021 census, we were at, I think, 25,500 something, right? So there's a substantial increase. And when and a large portion of this increase is because of migration, your student visas, your temporary visas, and your migration, where permanent residents coming in, right? And they don't come in with their fridges, they don't come in with their microwaves, they don't come in with their iPhones. Well, maybe they do.
Yeah, I was going to say, yeah, yes, they do.
So what it does is that they come in and buy, right?
Yeah.
So therefore, consumer spending will still be at a high level, and they would initially come in and rent. And when you look at data right now, September, year on year, the building approvals were down by, I think it was 4.5%, right? Which is the lowest it's been down in any month, which translates to about 15,000 dwellings.
Yeah.
Right. Now, mind you, Brisbane dwelling approvals and Tasmania dwelling approvals are up because I suppose everyone's starting to say, you know what, now's the time to amplify my income. I'll build a secondary dwelling, or I'll build the house on the land that I've got, because I can get top rent, right? I'm doing that in my portfolio, even though the cost to build is much higher. So when you put all of that together, we know inflation's not going to go away. Yeah, with the increased rent, increased consumer spending, increased population, it's not going to go down to the 3% anytime soon.
No, I agree. I think we'll see a bit of a chasmic fall off in the very short term, and then that'll be that step down, and then it'll level off, right? Because of all the reasons that you just said, and let's not forget that this necessity for roofs over people's heads, driving rent up, lack of accommodation, is also contributing to where the inflation numbers is, as is the cost of fuel, which is up through the roof, and so on and so forth. And all of those things that, the heavy hitters of inflation in terms of the last data outputs is really rate non-reliant. So putting the rates up isn't going to
It's not going to change that.
It's not going to change that.
Yep.
And I guess that's the argument for a lot of people is it's like, well, what other instruments have you got in your bag, Governor?
Yeah.
Nothing.
So I guess we can confidently say that the property prices are not going to come down. Regardless of the rate being high, the prices are not going to be coming down. There may be...
In some areas, I think there will be,
there may be more distressed sales because people can't afford to hold on. And as we traditionally see post-Christmas is that people have that big expenditure. If they're already in trouble, they'll have that last hurrah over Christmas. And then the credit card bills start rolling in, and most solicitors fire back up at around 10th January or thereabouts, which would mean that the person that needs to sell, that's when they're getting in touch with the agent, then to the solicitor to prepare contracts. So the properties really hit the market late January, early February.
Best case.
Yeah, best case, yeah. And then also... And the reason why it's not going to come down substantially, apart from the lack of supply, is that you've also got the New Year's resolution factor kicking in. I'm going to buy property this year. Right?
Yeah, I think that's a good one. But I think that'll be, and I don't want to sound like I'm pessimistic or it's the end of the world, because it's certainly not. It's a real opportunity, which goes back to, I think it was our last podcast or the one before, the size of the problem dictates the size of the opportunity, right? But there'll be a bunch of people that'll say, yes, I want to buy. And I believe that this 0.25 that we've just had will be the straw that breaks the camel's back, going back to the analogy, in terms of borrowing capacity.
Yes.
And so how does that play out? So, and I'm just going to throw numbers around. If you had your heart set on something that was, let's call it $800,000, $900,000, and this last point, and you just snuck in, right, and this last 0.25, as well as other factors, have reduced your capacity to borrow, not at 800,000 or 900,000, but now you're down to $600,000 or $700,000, and potentially, if you want to go the higher level, you're with a third or fourth tier lender at a much higher rate.
Yep.
And so then you start to do your numbers, and you go, well, I can't afford that. And if you really wanted to buy, it's going to funnel you into that more affordable corridors, which is what we're seeing already and have had for the last 12 months, which is why we've seen the affordable corridors throughout most of Australia react really well, growing in value. But there's also, that's from a purchasing point of view, right, in terms of those affordable corridors, but there's also the affordable corridors for renting.
Yep.
And as we've mentioned before, it will get to a point where there's a natural ceiling on what someone can afford to pay for rent.
Because it's tied to the income.
Correct, right? So it's just like the mortgages, but from a rental point of view. And so they'll seek different alternatives, whether that be they go a little bit further out into the affordable corridors, whether it means they share house, which the data's showing that
is happening.
That is happening. So there's a hell of a lot of moving parts here that are tied to this 0.25, both from a physicality point of view, but also from a psychological point of view.
Yeah.
And it'll be really interesting to see how it plays out, which kind of then rolls into the traditional Christmas period. And is it a good time? And the question we get all the time, is it a great time to buy? Or should we sit on our hands? You know, what's the answer? And there was a time, as I sort of sidestep a little bit, there was a time, Vic, where we used to love Christmas.
Oh yeah, absolutely. We would be doing purchases at Christmas Eve.
Christmas Eve, yeah. It because what used to happen before, and I truly do believe it's technology and education, that combination. There was a time when people just checked out.
Yep.
Just mentally, it's Christmas, I'm on holidays, I really don't want the hassle of buying or whatever, but the seller still wanted to sell, right, because their property was on the market already. So the choice became more abundant. The agents wanted the deal across the line. The sellers wanted to get into a position where, we know that going into Christmas or just after, we've got a signed contract, and it was a great time to purchase. Then as technology evolved and education evolved and instant news evolved, what I've noticed is that Christmas now becomes a little bit hit and miss.
Yeah. It's been like that for a couple of years.
Yeah, and probably about 5 years,
Yes.
I want to call it, where you think it's going to be rubbish and it turns out to be pockets of goodness, as a buyer. And then you think it's going to be good and there's nothing.
Yeah.
And this year I'm still on the fence on whether it will be that, whether it'll be good or whether it'll be bad. And so here's my crystal ball gazing for Christmas. Don't hold me to it. I think Perth will continue to be super, super, super hard.
Yep.
And just on that, on Perth, just to throw some data around, I think the official days on market data for Perth is 9 days or something like that, which is horrifically, diabolically low. Our buyers agents are saying 9 days, my foot.
That's really good.
Yeah, it's more like somewhere between
9 hours.
Yeah, it could be. In some cases, it is, right? But it's like somewhere between sort of, let's call it 2 to 5 days. Yeah. And if it gets to the upper end of that 5 days or more, it's because they want to run another open home. Just
not because there are no offers. They just want the higher
They just
price.
want to extrapolate everything out of it, right? So in a market like Perth, I think it'll be same old at the moment. I think it'll be a very tough market to buy in, and it'll come down to relationships, speed of action, and diligence beforehand.
Yeah. Look, and on diligence, Steve, one of the things we're noticing is there are a lot of people in the general public, as well as some buyers agents out there, that are just making offers on property sight unseen and without any finance clause or best crazy clause.
Yeah.
This is the hallmark of an absolute bloodbath when all the action goes away and you realize what you've really bought, right? You can't shortcut the diligence.
We've, speaking to one of our buyers agents in Perth yesterday, we got smashed on 3 properties over the last 7 days where it was from East Coast buyers, completely sight unseen, with, on the surface, very, very little diligence. And as to your point, voiding some of the terms and conditions. So sight unseen, no terms and conditions. So that means really pest and building and finance clauses, right? So it's absolutely suicidal. You are rolling the dice, and sooner or later you are going to get really badly hurt. And so it really perplexes us when we see these offers and we go up against these people where, bought this with the help of a property manager or no one that's physically visited the property. It's just, for us, it's just madness, and we don't subscribe to that. So that's Perth. I think Brisbane will continue the same. Brisbane's a very, very buoyant market. It has rebounded and some. Yeah. Both from a tenancy point of view and from a asset value and growth point of view as well. And there's some interesting stuff just for our clients that they should know. The flood mapping throughout a lot of Brisbane has changed.
Yeah, significantly.
Significantly. You say the word. It's changed a lot. It's to the point where there's going to be a lot of people that get caught out that don't do the proper diligence. So for any of our clients, we're just putting together some information for you so that you do know what these changes are, and that's to the north, the south, and the west.
Yep. And this will flow through to other states as well. In fact, some of the other states have already done it. It just hasn't been as pronounced. And it does have an impact on where you can buy now. So there's a gap in the market right now where the knowledge is not transparent.
It's a knowledge gap.
Yeah, there's a knowledge gap. Yeah. So this is where in buying in Queensland, you really, really need to do your diligence on it.
And what's the ramifications of that? So the obvious ramifications are something that, and this is a very short version of this, of quite a long and intricate story for it. But
we might do a separate podcast on it as well to
we might
fully map it out.
Yeah. That's actually a good idea. But just for this podcast, basically things that weren't classified as flood affected yesterday, today are.
Have got a grading of flood, right?
Correct.
So it's low, moderate, or heavy.
And there's 2 ways that could roll out badly, and actually there is some positives to it because before it was pretty black and white. Yes, it floods. No, it doesn't. Now it's that grading scenario. But what it will do, and I'll just give you a very quick example. There's one suburb in Brisbane there where there's literally only three streets that are now not flood affected. And we're not talking back of nowhere. This is a major metropolitan part of Brisbane where there's only 3 streets that aren't flood affected now in some way, shape or form. So if you play that out, and I know we're digressing as we do with every podcast or Facebook Live, if you play that out for the future, when you have these different gradients of flood affected areas, it reduces and condenses the size of usable land.
Yep.
So therefore there's less now that can be developed for subsequent accommodation, which puts more pressure in terms of a lack of accommodation in that medium to long term, unless they open up other corridors. But in a place like Brisbane, that's really hard.
Yeah, which sort of plays out when you look at data, right? So Brisbane, so overall in Australia, the building approvals have dropped substantially in September, right? But Brisbane's actually gone up, I think it is from memory, 18%, right? Because people that are savvy, they've looked at this flood mapping and said, I'll be smack bang right in the middle of it. I'm going to bring forward my approval. I might not build right now, but I want to lock my development potential in.
Yep.
So this is where you gotta be always. Properties never set and forget, right? They're rolling changes, so it is a sovereign risk. Council changes stuff, government changes stuff, and we need to roll with the changes and adjust strategy, adjust the outcome of the property as such, right? So for those that are owning properties in Queensland and that are RPG clients, we will be reaching out to you to talk about the changes that you need to do. For some, nothing. For others, there may be a little bit of tweaking to do, but it is definitely, I see it more as an opportunity than a problem.
Absolutely. So just as Vic's just mentioned, just to repeat for the RPG clients, don't smash us with emails and phone calls and text messages over the next week. We're just putting together the information and we'll come to you. Yeah,
we want to see how everything lands before we come back to you. So first of all, this flood zoning changes is very new. Then we also want to see how the development side of it is impacted, what the feedback is from the builders, and also the feedback from other stakeholders in your performance of your property. So it's more likely that all of this will land around February, March next year.
I would say so.
So that we've got pertinent information and not reactionary information, which is really important in investing, right? So if I then bring it back on song, what people do wrong in terms of investing is that they are more reactive to the problem rather than looking at all the moving pieces to say, okay, this is where the global impact is. This is where the impact dribbles down to me, and this is what I need to do. They look at just the global, skies falling in, they react accordingly, and they lose the opportunity.
There'll definitely be that. There'll be a heap of people that just have this knee-jerk reaction and will go buy.
Yep.
And there'll be a heap of people that go buy to my asset.
Yeah.
I'm going to sell it right now because I guess the top line information which they don't quite understand yet.
Yeah.
But let's just come back to the Christmas markets because you've changed the subject again, Vic. I think the ones that'll be really affected in terms of volume on stock on market will be Sydney and Melbourne.
Yes.
Because of that debt to income ratio piece.
Yeah.
It doesn't mean that there'll be a flood of properties, but I think it'll be segmented into sort of 4 markets, just generally speaking. The absolute rubbish properties, so the properties that are...
You need to stay away from.
Yeah, the stuff that's like on freeways, under power lines, in obvious flood corridors. Side note again, some of these mapping changes is also applicable to Sydney.
It already has happened.
Yeah, Wollongong and Victoria. So those properties will sit on the market longer and you'll see the biggest price, I guess, reduction on those. Yeah, which will affect the mean average data. So we've got to be very aware of that. I think the good properties will still sell relatively quickly because it's just a lack of stock on market, right? And the investors who are cashed up in some way, shape or form will have the capacity are just picking the guts out of it now. Something that might have a bit of zoning or well located or whatever. And I think that there's the potential for the uber blue chip market to probably keep going the way it is. And then the blue chip market, there might be a bit of a hiccup there just because affordability once again. And then there's that first homeowner market at 2%, double income, no kids.
That now have got kids.
That are now double or triple the interest rate with kids, maybe one income.
Yep.
there'll be a bit of pain there, and the same could be said for Melbourne as well. And I would be with both Sydney, Melbourne, Brisbane, Perth, anywhere. I'd be just very, very careful around where you're buying, and look at, obviously the short term is important because that gives us a psychological kick, but where's it going to really sit over the medium and long term?
Yeah. And if you bring it back to things that people do wrong leading into Christmas and out of Christmas, people start looking for discounted properties. Really, what you should be looking for is opportunities.
Value.
Right? Yeah, value.
Yeah, because value's in the eye of the beholder, right? And I know we've mentioned this many, many times, Vic, just to jump in. Too many people associate how they negotiate and what price they'd like to buy something at based on the asking price of re.com or domain or whatever it may be. The asking price is irrelevant in most markets.
Yep.
It's just a fact. Yeah, if we let's take I don't know, Brisbane and Perth. Probably 8 out of 10 cases, the asking price is irrelevant to the point that it's going $50,000, $60,000, $70,000, $80,000 over the asking price, because the agents are struggling trying to actually put a value on it, right?
Well, if you look at the mechanics of it, right? So when let's say I'm an agent, I'm coming to your home to appraise, to sell your place, right? I've got the same tools as everyone else, which is CoreLogic, and CoreLogic will spit out a range. Right? And even if I pick the top of the range, I can't inflate it more than 10%, even though the market is willing to pay a whole lot more, because this data is already dated. That's on CoreLogic, right? So it's probably at best 6 weeks old, and 6 weeks in today's market is very, very long. Right?
It is.
So therefore, let's say I'm quoting 500. The market's already moved to 580, but I can't quote you 580 because I'm bound by law to not overquote or underquote. I need to show substantiation as to how I came up with that number. And therein lies the problem, right? So a lot of people say, well, you've paid too much for it. Sometimes, yes, absolutely. But in most cases, you need to understand the mechanics driving the pricing and how things are priced to determine what value is. And then, of course, the second thing that you'd really look on that is, what is the value to you? Not to in terms of purchase price, but what is the property value to you? So let's say you owned the property next door, and by adding the property that's up for sale into the portfolio, that gives you a substantial development side, you'd pay above average.
We could dollar cost average, right?
Yeah, absolutely.
Yeah, and we do that.
Yeah,
we do that quite a lot, especially if we bought the property 7, 8, 9 years ago. Yeah, we can pay that little bit more at dollar cost average for the opportunity.
Yeah, so looking at the global impact of that purchase into your portfolio.
Yeah, but as you mentioned before, be very careful. Just because you buy next door doesn't necessarily make it a development site if there's any upside. Yep. So diligence. I think some of the regional markets, Vic, just coming back to Christmas, will continue the way that they're travelling, and it's a very fickle market. The regionals at the moment. There was a little bit of contraction in asset value. The vacancy rates increased a little bit, but now they've come back as affordability really bites. Right. But then there are some of the smaller economy regional areas which are still on their slippery slope, so to speak. So if you're entertaining regional, be very, very careful where and what. And why.
And we've been on record to say be very mindful of the performance of regional in terms of big growth. We had big growth because there's big demand, but now the demand is slowly ebbing away because we are being called back into the office, right? So there's a move back into metropolitan for quite a few people, which is then easing the pressure. And we're not saying that regional investing is bad. Regional investing is just as good and or lucrative, but you got to get all your stars lined up so that you're not behind the 8 ball with that area.
This comes back to my earlier comment around the short term, but you have to look at the medium and the long term as well, because some of these smaller regional towns, as happens in metropolitan areas as well, is that you get an initial run on growth and then you get nothing for a considerable period of time. And when you start to average that out, your money would have been better off elsewhere. In terms of the growth and the workings of it for you over the long term. So just make sure you keep that in mind. The rest of so I guess in summary for the Christmas period, I think I'm 50-50 on whether it'll be a good or a nothing time. Nonetheless, we need to keep looking.
Yep.
I mean, that's our job. And even if you're an investor doing it yourself, don't switch off at Christmas. But bear in mind that your team, so whether it be us, whether it be your accountants, whether it be your brokers, your bankers, your pest and building inspectors, your solicitors, they're all going to bundy off. There'll be a time, and it's usually from Christmas Eve through to about the 5th, I think, or thereabouts, where it'll be very hard to transact in anything. And even if I extrapolate that a little bit backwards, if you're purchasing now, just check your settlement dates.
Yeah, absolutely.
Because you don't want to be settling in that sort of black hole period where there's no one available for you. All the way down to a pre-settlement inspection. So just make sure you count the days on your contract and stack it forward or backwards, I guess.
In fact, that's one of the mistakes that people make, right? Is they don't count the days to settlement. So they just go in on a standard contract and exchange on a property, and settlement may be 24th December, right?
Yeah.
Or it could be 5th of January. I don't know what 5th of January falls next year, which day, but let's say it fell on 5th of January, yet the solicitors are back 8th or 9th. And then in between also, the lender gets smashed with work, and so they have a blowout time, right? So if you're then promising, as an example, one of the negotiating tools that we commonly use is getting the owner to stay back and say, actually, no, to vacate. So we will settle before Christmas, so they can get spending money during Christmas, right? Depending on the motivation. There are others where we'll say, well, we'll settle next year because you can have another Christmas at this place. So we need to find the motivation. But those that are saying we'll settle before Christmas, you need to be checking in with your lender. You need to be checking in, like you said, who's going to do the pre-inspection. And then equally importantly, if it's vacant, it's likely to be vacant for 2-3 weeks after it settles. And if there's no property managers available and all that, how do you guarantee the security of your property that's vacant over Christmas period with lots of people with idle time on their hands?
That raises a really important piece of the puzzle, and another digression from the subject somewhat, is let's really quickly, just off the top of our heads, create a checklist for the listeners on what they should be looking at for Christmas. So I'll go first because I've got a short attention span. It's in my head.
So first checklist, have a longer attention span.
Make a list for the list. See, go on. No, you interrupted. So the very first one is check your insurances.
Yes.
Right. There is so many people that's insurances lapse at this time of the year. And depending on who you're in fact, all insurers don't just rely upon snail mail or an email for renewal. As we've mentioned this time every year, is set calendar events for your insurances a month before they expire, so that when your calendar event goes off, at least subconsciously you're looking for the renewal.
Yep.
And I should practice what I preach, because I was just doing a random audit on my portfolio last week or the week before, and I found out that I'm uninsured on 2 properties because my calendar events didn't go off when I swapped phones.
You know what? I do a little bit smarter. I have Gmail as my email client, and I use the send later function, and I send 1 week before their insurance is expired to check. Right now, of course, if you're skimming your emails like you do, Steve,
correct. then it's useless, right? So insurance. The other big one is I'm a massive advocate of not having rental leases end anywhere from mid-November through till basically the end of January. So that's my sort of my blackout space. And how do I get around that, especially if I'm buying now, or and so they get a tenant now, is I stack the lease in terms of time. I bring it forward or take it longer, so that I'm out of that point.
13, 14 month leases.
Correct.
Instead of just standard 12
or an 8 or whatever it may be, just to get me out of that period. Because no matter how hot a market is in terms of tenancy, it's just a bugger of a time of you to find a tenant, because people just aren't in that headspace to organise removalists and so on and so forth. So just make sure that you're out of that time zone, I guess, for leases.
With insurance also, right? So as you get closer to Christmas, you do get embargoes on new policies, right? That is true also when you have natural disasters. So as an example, if there is heavy flood in an area, you will naturally get an embargo. So what embargo means is that you can't put up a new policy. And one of the other things that people tend to do is they get into Christmas, or on the other side of Christmas, their New Year's resolution, let's look at all our costs, everything. They tend to then change insurers, right? And the thing with insurance is whether it's life, whether it's health, whether it's property insurance, they don't cover pre-existing conditions. Right?
Correct.
So if your tenant is already in arrears, don't change.
Speaking of tenants, this is the time of year where you really need to monitor your statements. Yeah, so just be, and I'm not being over the top or that evil landlord, but everybody has increased expenditure at this time of the year, right? So for Christmas, so you really want to monitor your rental income to make sure that it's on check. Stay on top of it. Conversely, also stay on top of your own expenditure, which means your mortgages. Yeah. So while you're on holidays and you're mentally checked out, make sure that you've got enough in your redraws or your offsets or wherever your mortgages come from, your automatic drawings. Make sure they happen.
Yeah.
Because you don't want to have a semi-default, which will take forever to explain when you try to get a loan next year.
Yeah.
So just make sure that there's enough funds and you follow the trail. We're only talking, 2 months, really? Two payments.
Yeah.
So it's not that hard.
Yeah, that's right. And then, so further adding to the checklist, right? So we want to also make sure that we have especially if you're going away, you have communicated with your property manager and you've got at least 2 methods of contactability, so that they know how to get hold of you should there be something that needs decision making. Right now, obviously, for essential items such as broken stoves, hot water system, all that, the agent by law has got the authority to spend that money, regardless of what your property management agency says. Right. However, I would like to have a say in it still, in terms of, okay, it's going to cost us 2,000. Hang on, I know this plumber who will charge me 1,800, and you want to be preemptive on your maintenance going into Christmas, because if it breaks over the Christmas period, particularly hotter systems and stoves, if they're on their way out, maybe attend to it before Christmas, because during that holiday period you'll be charged an arm and a leg.
Yeah, good point. Which I think on that vein as well, if you're in a position to have the expenditure now, I think you'll actually save yourself some money by this time next year. Well,
we've got inflation, haven't we?
Well, apart from true. Good point. Valid. But apart from that, I just think there's going to be an escalation in the cost of all trades, all materials, or building next year. And even though, once again, digressing, even though the data from HIA shows us that the cost of building has stabilised,
it hasn't come down.
Yeah, it hasn't come down, but I think it's a momentary lull.
Yeah, well, I'm doing a few constructions, right? And if you look at simple things like Bunnings will not allow you to take things in bulk, right? So if you got timber there, they will not allow you to go into their warehouse and take bulk stuff. You have to pre-order, and then there is a wait time for the order, right?
Correct.
So the supply did get resolved, but it's now starting to become a lot harder again. And this is something going into Christmas that you need to be mindful of. Now, coming back to the checklist, the other thing that if you are in the process of buying properties, right, and you want to set yourself up to say, hey, I want to pounce on an opportunity, don't leave your refinance till too late. So how lenders work is that as you get closer to Christmas, and usually the cutoff is around the 10th or 15th of December, they will then start prioritizing purchases as opposed to refinances. So your purchase, especially when you're doing it the right way, you'll be refinancing with one lender and getting the bulk of the purchase money from a different lender, right? So this lender does not, so the one they're refinancing with is not worried about your purchase because they've got other purchases they need to prioritize. So your refinance application does not get the attention. So you need to have your run for the refinances a lot earlier going to Christmas. And if it's usually with the same bank, then there is a little bit of a priority on the refinance because one affects the other. But if they're 2 different banks, which is structured correctly, then you'll struggle to get the money to settle even though your incoming bank is ready.
It's a really good point because, and we see this every year.
Every year.
And it's actually happened to me, whereas, my refinances have been shelved at this time of the year because of that very reason.
Yep.
They concentrate on purchases, and there's a multitude of reasons. One's because it's contractual with the purchase, and two, they're on skeleton staff.
Yes.
Yeah, really, really interesting. So what else to the checklist, Vic?
Well, certainly, if you're looking at, especially if you're self-employed, right, make sure you know where your accountant is, right? Especially if you're purchasing. I know with our accountant, I hassled him when he was in Denmark 1 year over Christmas because the lender in the last minute wanted a letter off the accountant. This is a couple of years back. But that is something that you need to know where your team players are. And how contactable they are and how they can be contacted. Now, obviously, you don't want to be sending them emails about mundane stuff, right? You need to also be respecting their time and their time off as well. But
no, you don't. When it's about you, it's like, well, pick up the phone, answer the text. It's
only send emails and phone calls to Steve.
Yeah. It's a bit like one of my personal accountants. The great accountant when you can find them, and you know who I'm talking about if you're listening, accountant. Pick up the phone. It's another subject. There you go. There's another podcast. Who's your team players and what to do when they don't perform.
So we've
that
got
just opened up a can of worms in my head. Then.
It has, doesn't it? Yeah. So if we've got obviously we got to pay attention to insurance.
Yeah.
We're going to pay attention to your statements.
Correct.
Right. We're going to pay attention to maintenance going into it. Pay attention to your refinances as such. The fifth most important is pay attention to your emotions, right? Because just because the property is there, your pre-approval is running out, and you then compromising on quality and thinking she'll be all right, it might not be the right property that's in tune with the rest of your portfolio, right? And the flip side of that coin also is that don't overanalyze. Still address the fundamentals, but don't overanalyze. Why are they selling? Why are they wanting to settlement before Christmas? Why aren't they settling before Christmas?
Which brings in land tax.
Yeah, that's right. It's an important one.
Absolutely. And actually, it's a really good point that you bring up. Like, don't overanalyze the reasons for a seller selling. I mean, often you're not going to get told the truth.
Yeah, and a lot of times, the novice investor, they turn around and say, well, they bought this in 2021 and they paid only 500,000. We're paying 700 for this, right? Maybe they've done work with it, and the market certainly has gone up, right? So you've got to look at it not from how much they've bought it for, which is something we struggle with, right? How much they've bought it for. It's what the property is worth to you today.
It's a really good point, because if you look back at purchase prices and try to emulate 3, 4, 5 years ago, 10, 15 years ago, whatever, you'll never buy another property.
Yep.
Because you'll never hit that benchmark.
That's right.
Again. Like it just won't happen, right? And hoping for this. And I was reading a couple of financial forums the other night, and the amount of, I'll call them sophisticated investors that are praying for a crash.
Yeah.
And yet that's their space, right? So they're into real estate, these particular financial people, and they're all saying, bring on a crash, bring on a crash, bring on a crash, because they feel, and this is in their own words when you sort of go through the forum, they feel they missed the boat at the beginning of COVID and at the end of 17 when APRA released the handbrake.
Yeah.
And so they want to see a reset back to that, but it's just not going to happen. So if you're waiting and praying on this crash, I think you're a bit sick-minded.
Yeah.
Firstly, but secondly, if you're just doing it for the reasons I just explained, you're going to be waiting. It won't happen.
You know what the problem there is, Steve, is that they are not able to change strategies or modify strategies.
Yeah.
The approach to investing as the market changes, right? So they're only a one-trick player in that sense, right? They've only got one trick up the sleeve, and that's what they continue playing because they're good at that.
Correct.
You need to be versatile to be able to adjust to different things. And one of the we had a snippet on Facebook, and one of the comments that I noticed recently was about how if you are giving a lowball offer, it's not the right play, right? And there were a few negative comments in there to say, why wouldn't you? Well, you won't get a second look in when you give a lowball offer in today's market.
Digress again, because that sort of arcs me up a little bit. It's those people, and I didn't see those comments, but those people that sort of make those comments facetiously clearly don't know what they're doing. And we have done a podcast on that, or a Facebook Live, in saying that the tempo of the market will dictate the way that you negotiate,
Yeah,
and the
absolutely.
style that you negotiate. And you mentioned something really important, which ties into the Christmas scenario, is that if you, in certain markets around Australia today, if you go throwing offensive low ball offers, you will not get a second look.
No.
In some parts of the country today, it's hard enough to get a real estate agent to answer your phone call or ring you back, let alone you throw something offensive at them in terms of the
You're
offer.
getting them to work.
Yeah, correct. And this is their moment to shine egotistically as well. Look how much I got for the property. So if you offend them, you're not going to get a second bite at the cherry, right?
Yep.
However, there are times when we do suggest you what we call open extreme. So you do go in with a massive low ball.
Yep.
But it's not this market.
Yeah, absolutely. Even our auction tactics have changed in this market.
Absolutely.
Right? So, my modus operandi on auctions is go such an offensive low ball offer that it just shocks the auctioneer. I can't even afford to do that, right? Because I need to be within the guidelines. Otherwise, I'm not being. The agents won't even approach me to say what's your next bid.
Well, the auction, and
Or you get laughed out.
Yeah, and we know a lot of these auctioneers, and they'll say, no, Vic, no, Steve, we're not taking that offer.
Yeah.
And it's like, well, okay, you don't have to, whereas you used to, but now it's a different playing field. So we've got to adjust for that. But anyway, so the way that you offer during Christmas will also be very, very important as well as the timepiece in and around the contract for settlement and even for unconditional exchange as well. So put that on your Christmas checklist.
Because the unconditional, and it's good that you brought it up. It might not take 10 days. It might take longer because the volumes with the lender may increase, and also they may be down to skeleton staff very quickly as people go on leave.
Correct. Just because you're approved in principle doesn't mean you're unconditional. Is just a tick box.
That's right. Yeah. So there are your checklists going into Christmas, and I think it ties in beautifully with the rate rise and the tempo of the market and what we can anticipate next year with the substantially increasing population, then therefore the inflationary pressure on rent and cost of living, which won't bring the rates down, obviously. And also, it won't get the property market to crash. So if you're waiting for that big crash, it may be a very soft landing that you may fail to recognize because it'll rebound back up very quickly. We are so undersupplied with low development approvals month on month, and rents continuing to increase and population continuing to increase. It just simply cannot crash.
The other thing I'd probably want to throw in there, Vic, is from an ethical point of view too, for our tenants, because we've all been tenants at one stage or another, right? Just have a good bone.
Have a heart.
Yeah, have a heart. It's a tough time of the year for a lot of people. And a lot of people are going to be doing without because they're redlining on budget, whether they're owners or whether they're tenants. So have a heart, be a little bit flexible, as long as there's good history there.
Yeah.
And don't be that evil landlord. It doesn't. Karma's a thing.
Don't be a Grinch, Steve.
Don't be a Grinch. That's not in my nature, Vic. I know. But yeah, have a heart, do the right thing, and it'll pay dividends. Don't be the evil.
Yep, absolutely.
landlord.
Yep. So at this time, obviously, you would be starting to think, okay, have I left my run too late for this year? Maybe not. You can do all of the pre-work this year. Certainly there'll be opportunities around, but you need to be talking to the professionals to set yourself up so that you're not making New Year's resolution next year and then work takes over that New Year's resolution very quickly. You need to start the momentum now. So we are only a phone call away, or an email away, or social media message away. You do get to speak to either myself or Steve, but there is a little bit of a process so that when you do sit down in front of me or Steve, we're actually talking strategy rather than trying to get baseline information of you. So when you initially contact us, you will be talking to Kate Kakatos. Her knowledge in property, she has been with us 17, 18 years now.
Been a while,
right? And she's a really good investor herself. Learned off the best, obviously. And she will then get all the baseline information, explain how you work, and we'll then set up a time for either myself and Steve to have a chat with you.
That brings us to the end, Vic.
It does.
You opened, you can close.
Absolutely. So if you like this, give us a rating, thumbs up, or a star rating, depending which platform you're looking at. Do share our podcast with your social network, because it does help with our algorithms. And be sure to subscribe if you haven't already.
And we will see you next time.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.